and welcome to Smart Investing with Nosa. This podcast is hosted by me, Nosakare Ugiagbe. It's almost Christmas and the coronavirus situation hasn't improved significantly. In fact, the number of positive cases has gone up in a lot of cities. So don't take it lightly. Continue to protect yourselves and your loved ones. Continue to maintain a safe distance if you have to go to work, or if you do not have the luxury of working from home. It's still important to protect yourselves and your loved ones. When you go out, wear a mask and observe all other social distancing rules currently in place in your respective cities. In today's episode, I'll be doing a recap of some of the individual securities that I added to my portfolio this year. However, before I begin, I would like to state categorically that I am still very much in favor of not buying or holding individual securities in your portfolio, especially if you are an unskilled or inexperienced investor. Buying securities in a year or two, every other month with the savings from your salary, and watching a few YouTube videos do not make you a skilled or experienced investor, okay? I don't even consider myself a very skilled or very experienced investor. And as a matter of fact, I have been studying finance and accounting and investing for most of my adult life. I am a CFA Level 3 candidate. As a matter of fact, I have prepared for the CFA Level 3 exam twice. So I took the exam in 2019. Unfortunately, I failed it. I prepared for the exam again this year with hopes that I'll take it in June, but it was cancelled due to the coronavirus and postponed until December. So I kept studying for it, and even the December exam was postponed again until May 2021. So I've basically been preparing for that exam for almost 2 years now, and I have passed the first two levels of the exam. Despite all of this, despite all of my education, despite my career experience, despite my personal experience with investing, I wouldn't call myself the most skilled investor. I don't have the resources that many of these investment management firms have at their disposal. I don't have the relationships, I don't have the technology, and I don't have the time, to to monitor markets and review information. I don't have the access to most of the information anyway, and as a result, it is difficult for me to have superior information year in, year out than all of these really smart people who are probably CFA charter holders themselves, or are training under CFA charter holders, or are training under people who have years and years of experience in investment or asset management, are training under and have a lot of supercomputers executing trades for them. They have relationships, they have access to information that you and I don't have. They have representatives sitting in some of these analyst meetings where corporations disclose important financial information which often drive the market. You and I would probably read about this information on the news a day or two later when Bloomberg or some other company reports on it, right? So the odds are skewed against you and I as individual individual investors, And as a result, it is impossible, and I say this with confidence, it is impossible for us to beat the market consistently. You may do it 1 year, 2 years, and you're lucky and you generate superior returns, and you think, oh wow, I'm so great. It's a lot of the time it's just luck. You can't repeat that level of performance year in, year out. So what's the alternative to investing in individual securities, you may ask? I have talked about this a number of times on the podcast. I have also written about this on my blog. Rather than obtaining exposure to a particular security, you can obtain exposure to particular industries or particular markets through ETFs. So you would have access to a lot of securities and you would be buying diversification at a relatively low price. I wouldn't be discussing ETFs on this episode. I've talked about it many times in the past, so feel free to check some of the older episodes or my blog for the articles on investment vehicles. So despite my position in favor of ETFs and against individual securities, I found myself buying quite a lot of individual securities this year, and I will explain. I'm not being a hypocrite here. You would agree with me that 2020 has been a strange year. It's been a very unique year, and a lot of things have not made sense this year. Well, we were hit with a pandemic that shut down most economies around the world. The pandemic drove down asset prices in most markets for most securities, including equity securities. I addressed this in April or March, where I argued, I think it's on one of the earlier episodes I made on podcast, you can check it out, where I argued that a global pandemic, which at worst case scenario, would impact global trade and commerce and revenues or cash flows for corporations for a maximum of 3-4 years, should not wipe out 50% of the valuation of securities, should not wipe out 50% of the market, because negative cash flows for a year or two or lower cash flows for 4 years does not justify a 50% discount on all of the future cash flows of a company. So how do you explain or how do you justify the significant decrease in asset prices globally? I would simply call that an overreaction. The market, as usual, overreacted to the coronavirus pandemic, and that sent asset prices down way below their intrinsic values. So based on this, I saw an opportunity. I recognized that a lot of the securities in the market were undervalued, and I directed all subsequent or most subsequent investments that I made to individual securities. You should, or you may know, if you know me, that I don't run an asset management company or an investment company yet. So all of my investments are financed by savings from my salary. So I get my salary and then I invest the allocation for investments accordingly. So I made all subsequent investments from the end of March until the end of November in individual securities. Secondly, I believe that the market or markets around the world have not been very efficient. That's probably because there has been a surge in the number of market participants in most markets. A lot of people lost their jobs. Many of these people had access to cash, and being out of job meant that they also had time. Being out of job with access to cash and without being able to go about your regular life, partying and having fun, meant that you had time for new activities. And many people turned to trading. Many of them were legitimately trying to get rich quick. Many of them just found it fascinating, the same way people find gambling fascinating. And so that has also impacted the market. That's another reason why everything that has happened in 2020, the meteoric rise in Tesla's share price, for example, beyond conventional wisdom, the extremely high price or closing price for Airbnb's IPO yesterday. So it's been crazy, and that's because there's a lot of new entrants to the market who are trying new things and who are driving asset prices. Anyway, for me, in January, I intend to go back to investing primarily in exchange traded funds. So I'm going to shift some of my portfolio back into ETFs, and I'm going to direct a significant portion of my subsequent investments back into ETFs. In one of the previous episodes, I mentioned or I addressed some of the securities that I'm going to mention today. I still have them in my portfolio. I think the particular episode was hindsight bias in investment decision making. It was quite an interesting one, so you may check it out if you want. The first security that I talked about then was Amigo Holdings. Amigo, is a guarantor loans lender. It basically offers loans to people who aren't typically covered by the conventional financial institutions, provided they could provide someone to stand in as a guarantor. So it's giving out loans to people that would be considered high risk by most financial institutions. So I bought Amigo at 5.1. 2 days later, it was at 10.5 and I sold, and I explained my rationale for that transaction in that episode I talked about. So you can check it out. So I no longer have this security in my portfolio. It was simply me trying to benefit from a market overreaction due to all of the negativity that was following the company at the time. And yeah, I think the share price is currently at 9 point something or so. The next company is Exasol AG, AG in German. And so it's a German company, obviously, and it's an analytics database management software company. I was particularly interested in this company and in its industry, its focus, and in the fact that its price had not performed significantly well since its IPO. It was listed relatively recently. So I went into Exasol at 12.49 or 12.5 basically, and it's currently trading at 24.1. So that's a 92.8% gain in less than 6 months, or about 6 months. The next one was the German Startups Group. So here, this is a venture capital firm that's listed on German Stock Exchange, and it had a lot of interesting portfolio companies, and it had done a lot of nice exits as well. I was impressed by their portfolio as well. So I bought this with the hopes of holding it for the long term as well as Exasol. So Amigo was short term, Exasol was long term. German Startups Group was intended to be held for the long term as well. However, they did a merger with SGT Capital, a global PE firm with offices in Germany and Singapore. I wasn't very comfortable with the merger. I read about SGT, and afterwards I decided to sell. So I bought it at 1.632. I sold at 1.87, and that's a 14.6% return. I think today it's currently trading at 1.7 euros. So yeah, good for me. The next one is Sensine Health. So this is a British company. It's into healthcare technology. It basically uses data and technology to improve patient care, and it's British, so it's in partnership with the British NHS, and I found the industry to be particularly interesting. Also, I had a bias for underperforming IPOs, so it felt like a good deal. The numbers looked right. I did some due diligence, and it looked like a good buy. When I initially bought this, I bought it at 36.6 British sterling. Subsequently, I bought some more at 75 sterling, so that's more than twice the amount of the initial purchase. Yeah, I strongly believed in the fundamentals for this one. and today it's currently trading at 124. That's 124 sterling. So that's about 143% gain since when I bought it, about 6 months or less. The next one is Vivarion Therapeutics, and it's a biotech company. It develops drugs that help modify enzymes and help treat Alzheimer's disease, cancer, fibrosis, etc. I was attracted to this one particularly because of its industry. First of all, healthcare is going to be big in Germany, and that's not just due to the fact that they are using technology and trying to cure very important diseases, but also because of the aging population in this part of the world. So the solutions, the problems they are trying to solve will need solving by a lot of people in the next decade or two. So those are the 5 individual securities that I held in my portfolio at the end of June. There were some other securities that I bought and sold along the line. And in August, I bought 22nd Century Group. So this is a biotech company again. It's a leading plant biotechnology company, and it focuses on technologies that alter the level of nicotine in tobacco, the level of cannabinoids in hemp or cannabis plants, and they do a lot of genetic engineering and gene editing in plant breeding. So, I mean, the world is going green. A lot of countries and states are starting to legalize the use of cannabis for leisure, and they are into a lot of partnerships with governments around the world, particularly in the US. It's a US company. So I was fascinated by the industry. I did some due diligence, and as usual, their numbers were terrible, really bad. Anyway, I was fascinated by the industry regardless, and I bought some at 0.63 euros. That's 63 cents per share. I initially bought about 4,078 shares at 63 cents per share. A few days later, they released, I think they had an earnings update, and the numbers were even worse. So the prices went even lower, and I bought some more. So my average price, I kept buying more and more. So my average price became around 0.57. So that's 57.5 cents per share. And I had almost 16,000 shares. So the first 4,000 shares I bought were because I was interested. I was attracted to the company. I was, banking on them succeeding with their technology, and I was banking on the regulations to change, not just in the US but in other countries as well. So I was hoping this would blow up and become a big successful company. The other shares that I bought, the remaining 12,000, was because I believed the market was overreacting, right? So I thought that the company was already loss-making. The price were already going down because the analysts expected negative results, and the announcements they made subsequently did not justify the further decrease. So I bought some more to benefit from the short-term reversal of that initial overreaction. As expected, as at November 18, the price increased significantly. It increased to around 0.95. So I sold 12,000 shares on that day at 0.95 because I was planning to hold my initial 4,000, just under 4,000 anyway. So I didn't want to have too much of my small portfolio in one company. Even if I'm buying individual securities, I still want to be as diversified as possible. No matter how much I trust my analysis and my insights, I could be terribly wrong, and then I would love to avoid a disaster. So I sold 12,000 units on November 18 at 0.95, that's 95 cents per share. On that day, the stock, the shares closed at, I think, 1.5 or 1.05. I almost, I felt so bad. I felt terrible. So I started to question, oh damn, why didn't I just wait a few more hours? And today, this particular company is currently trading at about 2.1 euros per share, 2.092 to be precise. So that's a 264% gain on the 4,000 shares that I still hold in there. But I lost the additional upside potential for the 12,000 that I sold. It's easy to beat myself up given the upside potential that I lost. If you do the calculation, I lost about 13,000 euros by not holding all of those shares for an additional 1 month. So if I had held on for just 20 more days, I would have gained like about 13,000 euros more. However, this is just my hindsight bias playing with me, right? So there's no way I could have known with certainty. And my decision to sell was driven by sound fundamentals. It was driven by a logical analysis. And I addressed the concept of hindsight bias in an earlier episode. You should really check that out. And in that episode, I explained how to deal with hindsight bias. And the first step in dealing with hindsight bias is being aware of the possibility of hindsight bias, knowing that you are subject or you are prone to hindsight bias. And the second step is to record and examine your investment decisions. So in my case, I had a sound logic for buying 12,000 more shares than I initially planned to. And I had a sound logic for selling those 12,000 extra shares because I didn't want to be overexposed to an individual security. I didn't want to be overexposed to the biotech sector as well. I wanted to move the extra cash to other securities to further diversify my portfolio since I was holding individual securities anyway. And the third step is to remind yourself that markets move in cycles. No matter what happens in the market, whether shares are going up or down, whether there's a crisis, good investors, good managers ultimately stay true to their strategies. Whether in good times or in bad times, good managers stay true to their strategies, usually because of step 2, because they can justify these decisions. And finally, it's important to know that good decisions do not always lead to good outcomes. So my decision to sell 12,000 units of this security, 22nd Century Group, was good. It was based on a sound analysis. And to be frank, I bought those extra 12,000 shares at 57 cents or so, and I sold them for 95 cents. And that's a 73% return on those 12,000 shares that I sold. And I held them for just a couple of months. So I took the cash realized from selling my 12,000 shares in 22nd Century Group, and as well as my allocation to investments from my salary in November. And I invested in a few additional securities. So the first one is 3D System Corporation. It's a US company. It's a company that's focused on 3D technology and its application to healthcare, to manufacturing and the automotive industry, to software solutions, and so on. I bought this one for 6.097 euros per share. And as at today, it's trading at 8.34 euros per share. So that's a 6.7% return. Not bad, huh? And I also went into the esports industry. So these are companies that build arenas to tell or to display electronic sporting activities the same way you would watch a football game or a boxing game live. And so some of them deploy technologies to develop their own games. They enlist players and teams to compete in tournaments like a typical football or basketball or baseball team would. So it's an emerging industry, and so I find what they're doing pretty interesting, and I think it would pick up in the future. However, the industry was impacted negatively by the coronavirus because a lot of their revenue depends on being able to allow fans and spectators come observe and watch the sporting activities, right? It's just like in football games. You no longer have fans present in the stadiums. So, and when that happens, the clubs lose revenue. So the same thing happened to the industry, and a lot of their shares took a hit. So again, I saw an opportunity here. My expectation is that many of them are undervalued because, again, the market, as it has often done this year, overreacted to the negative news. So I bought shares in Allied Esports Entertainment. That's a US esports company. I bought shares in Esports Mogul. That's an Australian esports company. So for Allied Esports Entertainment, I bought at 97 cents per share. That's in USD. And it's currently trading at $1.36 dollars per share. So that's about a 40% gain. Not bad, huh? And Esports Mogul is an Australian company. I bought at 0.019 cents in euros, or I think it's in Australian dollars, so Australian cents, and it's currently trading at 0.017. So there's a 10.5% loss on that security. The third company was Guard Esports. That's a British company. I bought at 6.9 sterlings. It's currently trading at 6.1 sterlings. So that's an 11.6% loss. I'm comfortable with the volatility and with the current levels of loss. And I'm basically buying into an emerging industry that's going through a rough patch right now. And once things start to pick up and the market realizes the level of overreaction, then I believe the price correction should happen pretty quickly. Another company that I added here, definitely not for its fundamentals. I don't believe, I wasn't very much attracted to the company's fundamentals itself. I bought this one because of the depreciation in its market value over a short period of time. And again, the market was reacting to negative news, and I saw some overreaction. So that's the Heidelberger Druckmaschinen AG. So this company basically manufactures, it's an engineering company, and they are into the manufacture of printing equipment. So it's headquartered in Baden-Württemberg. That's in the city that I live in the state that I live in. I bought it at 0.66 euros. That's 66 cents, and it's currently trading at 74.2 cents. So that's about a 12.6% return. Okay, so for the Heidelberger Druckmaschinen, I'm going to sell this off very soon, and then move the cash to ETFs. The next company that I looked at was Modern Meat Incorporated. So this is a Canadian biotech company that's focused on creating plant-based alternative meat products. And the world is going vegan or vegetarian. The world is moving toward a more sustainable standard of living. More people are getting drawn to consuming less meat. So rather than cutting off meat completely, this company tries to recreate meat without slaughtering any animals, without actually growing these animals, so without the toll that it would typically take on the environment. And there's also something for the vegetarians. So this is an industry that I expect to blow up pretty soon. I bought it at 2.845 euros per share. It's currently trading at 2.525. That's an 11.2% loss. Again, I'm comfortable with the volatility. Ultimately, in the long run, I expect this industry to do well. And if I am lucky, the company that I picked within the industry will be one of the successful ones. If I am unlucky, some other companies within the industry perform significantly well, while the others, become extinct, including the one that I have invested in. That's the case for investing in ETFs. So if an industry performs very well, despite the fact that some companies within that industry will underperform, some may even be driven out of business, if the industry overall performs well, you benefit from that growth if you are invested in an ETF. If a market, a country, an economy performs very well, if you're invested in that market, in that economy, through an ETF, you benefit from that growth, regardless of what happens to individual securities. I also bought Nutanix Incorporated. So it's a US-based cloud computing company that sells hyper-converged infrastructure software and cloud services, as well as software-defined storage. I think they released some earnings report or something. There was some news, and I saw a sharp decline in its value, and I got curious. I was curious, and then I looked into the company, and I saw what the news was. And I suspected an overreaction again. Like I said, 2020 has been a crazy year. So I bought it at 23.39 euros per share. It's currently trading at 25.58 euros. So that's a 9.4% gain. Other securities that I have in my portfolio are Novan Incorporated, a US biotech company, as well as 88 Energy, a Canadian energy company, as the name implies. So I'm holding these as well for diversification and for the long term. I am currently heavily exposed to the biotech industry, I know, and that's mostly because I try to capture some upside from the market overreaction to the coronavirus crash. And in the new year, I plan on moving a lot of my holdings in these securities to ETFs and have a more balanced portfolio. So far, year to date, I have made a total return on my equity portfolio of 125%. I'm going to talk about this in the next episode of the podcast, but in case you missed that one or you don't get a chance to listen, just know that such a high level of return is abnormal. It is extraordinary, and it is unlikely to repeat itself consistently in future periods. So don't be fooled by such a high level of return. Don't let anyone convince you that they are skilled and expert investors because they made double-digit or triple-digit returns in 2020. Right? 2020 has been an extraordinary year, and extraordinary things are bound to happen in extraordinary years. This has been a fairly long episode. I'd like to bring it to an end now, and I'll address the topic just mentioned on the next episode. Thank you everyone for listening. I look forward to seeing you again on the next one. Bye-bye.